We are entering an era of fiscal dominance, a fundamental shift in how economies are going to function for the foreseeable future. So, central banks, particularly the Federal Reserve, are supposed to be independent with a dual mandate to keep inflation under control and to promote full employment. But today, they're being backed into a corner because governments, especially the United States, are drowning in debt. America's national debt is now over $37.2 trillion and growing by about $1 trillion every 100 days. At these levels, even a 1% rise in interest rates adds hundreds of billions of dollars to the annual interest bill. So what's the solution? Keep interest rates at an artificially low level so that the government's debt burden is manageable. That's fiscal dominance. When a government's debt burden is so massive that the central bank is forced to abandon its inflation-fighting role and suppress interest rates just to keep the government solvent. And we're seeing it play out in real time. At the Jackson Hole Symposium, which is starting today, Jerome Powell is outlining the path forward for monetary policy in the United States, and markets have already priced in 100 basis points of rate cuts by next July, bringing the Fed's policy rate down to 3.25%. The U.S. collected $156.4 billion in tariff revenue through August, aiming for $300 billion by year-end. That's less than 0.8% of the national debt. Even if 100% of that revenue went to debt repayment, which it won't, it wouldn't make much of a dent. The federal government is caught in a trap. It can't cut spending because government outlays make up 36% of GDP, up from just 20% in 1950. In other words, if they reduce spending, GDP shrinks, recession hits, and the Fed is forced to act anyway by cutting rates and injecting liquidity into banks. So the Fed's only real path forward is to inflate the debt away, letting inflation run above interest rates long enough to erode the real value of what the government owes. This is bad for the saver. It's bad for the retiree who's on fixed income, but it's good for one type of asset: scarce, non-sovereign monetary assets like Bitcoin. Bitcoin in particular thrives in this environment. It has a fixed supply of 21 million coins, it doesn't rely on a central bank, and it's immune to interest rate manipulation or political capture. We're headed into a regime where real yields, the return you get after inflation, are extremely low. That's a tax on cash, a tax on bonds, and a slow drip expropriation of wealth from anyone who holds US dollars or US treasuries. In contrast, Bitcoin loves when the Fed cuts interest rates so long as they're doing it in response to a stabilized economy. In the last cycle, Bitcoin went from $3,000 to $69,000 during a period of artificially low rates and ballooning deficits. Now, granted, there are a lot of differences this time around, but the reality is that the debt is even higher, and the pressure on central banks is even more intense as a result. We're not going back to normal. We're headed deeper into abnormal monetary policy because there's no politically viable alternative. So Bitcoin is no longer just a hedge, it is a lifeboat. But don't wait for the US Treasury to tell you that, because their job is to sell you US debt. That's all for today's video. Thank you so much for watching. If you enjoyed, make sure to like and of course follow for more and reshare so more people can see this, and check out Horizon. Horizon lets you stack Bitcoin using your home equity without new debt, monthly payments, interest charges, or term limits. You can check that out at joinhorizon.com or by scanning the QR code right there. That's all for today's video. Thank you so much for watching. I'll talk to you soon.